Today on Rethink Real Estate, we have Chris Drzyzga. Now, Chris is an expert, if you ask me. He probably wouldn't call himself that, but I think Chris is an expert in all things commercial. He's obviously got his specialty, but today we have this incredibly wide-ranging conversation about the US marketplace as a whole, the individual sectors like office, industrial, strip mall. We talk about all different types of retail side of things as well. Chris, and I go into a pretty contrarian view of where the real estate world is going and where the devaluation of real estate could be going as well, with all of the alternative investment opportunities that there are external to real estate at this point. He gives us some great history on it as well. Again, really great wide-ranging conversation. I think that for those that are detailed orientated and want to understand where the market is going, ultimately this is great. But that being said, folks, it is a bit of a longer one, but we really enjoyed having Chris on. Thanks so much. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Chris, welcome to Rethink Real Estate.
Thanks so much, Ben.
I'm excited to have you here based on your commercial background. I always find that people that I speak to in the commercial industry, primarily not on the podcast because we don't have as many people on the podcast, they're always so insightful about the marketplace because you're dealing with a completely different audience. It's actually one of the things that I've taken away from many interactions with commercial agents in whether it be industrial, office, whatever it is that your insight to the market because of your clientele, it has to be so sharp and so poignant because they're making decisions really from an investment perspective, whereas there's probably more emotion injected into the residential side of things. If we can bring some of what you guys offer, to your investment clients or the people that are making decisions from a commercial perspective, I think that would probably sharpen up the industry a little bit rather than the emotional ties. But leading into that a little bit further, Chris, is that how did you get into the commercial space?
Well, first of all, thanks so much for having me. Excited to have the discussion this afternoon. I got into the space. I grew up around it. My dad was doing friends and family deals, as we call it, as I was growing up. So commercial real estate wasn't his primary job. He was doing it on the side with some buddies, developing hotels and retail centers out in Las Vegas, Nevada. So I grew up around the construction site. I loved sitting on the heavy equipment, pretend like I was moving earth, and always just loved seeing the project from start to finish and what it did for the community upon completion. So I always knew I wanted to be in commercial real estate in one way, shape, or form, and didn't waste any time when I finished college. Got right into it, into a brokerage role, and just kind of figured it out from there. Started investing very early on along the way, just sopping away commissions as much as I possibly could, and living beneath my means, and accumulating a portfolio slowly but surely. And I've been doing it now almost 15 years and never looked back. So it's done
that's wonderful.
Very well for me.
Well, I think that there's part of this that's a unique part is that typically people don't come out of college and go straight into commercial real estate. Like again, from a residential perspective, I come out straight out of school into residential real estate. But again, that might be a little bit more of a pathway where we're from in Australia originally. The industry is, probably definitely a younger industry when it comes to there. But if you go into the commercial space, you are well below the median age of a commercial agent, I would go as far as to assume. Has that helped, hindered for the people that are younger in any of the industries that they're in at the moment? What's the word of advice in that sense?
I don't know that it hindered. I mean, it really kind of put me on, gave me a step ahead, relative to my peers and a lot of my competition to some extent. I had 3 to 5 years of experience in the commercial world when a lot of my, peers, as far as just age was considered, when they were just getting started. It wasn't a disadvantage. Getting started in commercial real estate is not easy, no matter how you slice it, no matter the cycle, no matter the product type. I would say it's actually better to get started early when you can, afford to make some mistakes and fall on your face, honestly, and learn from them, rather than doing it when you're, in your 30s or 40s and you got, real life big boy responsibilities, in your personal life. So
Yeah.
yeah, I
Yeah,
wouldn't
for
trade it
sure.
for sure.
Well, I want to dive into what you and I have spoken about off camera here and off recording is your contrarian view on the real estate marketplace as it moves forward. And I enjoy somebody that isn't going to tell us that it's up and to the right. And even if you are going to tell us that, there's probably some nuance in that as well. But before we jump into that point of view, and this may segue into some of the things that we'll talk about, and we might even reiterate them with your general thesis. But I'd love to just quickly get a little bit of a rapid fire going of just the individual sectors, whether it be across the country, whether it be in your localized marketplace, being Southern California, but just a bit of an opinion on all of that, because I was listened to Blackstone put out their quarterly report for their investment thesis for 2026, and they're really looking at going back into the commercial marketplace from an office perspective, but more into the regional marketplaces. And I would classify Newport Beach, so to speak. We're in Fashion Island. This would probably be a regional marketplace. It's not a major downtown marketplace in any way, shape, or form. Is that correct?
I mean, as far as Newport Beach, I would loop. I mean, Orange County is a hub in and of itself. I mean, it's the Southern California hub for finance and um, professional services. We're even getting a growing presence or a growing market share in the bio and life science space,
Really?
pharmaceuticals. That was largely kind of the domain of San Diego, for the longest time, but we've started to see some of that bleed up into Orange County. But I mean, if you kind of look at the greater Southern California market, Orange County really is the hub for finance, wealth management, insurance. Again, a lot of the professional service firms
Yeah.
over LA. A lot of people
Yeah.
think that LA is the business hub, where I'd probably take the other side of that argument.
Yeah, and it feels like a lot of definitely from a residential real estate perspective, you've seen a lot of LA bleed into Orange County from a price perspective. There's no doubt about that Orange County has definitely seen an upward trend more so than say LA, or San Diego's always had a little bit more of an upward trend, just being from an affordability perspective in the residential marketplace. But have you seen a lot of the LA bleed into Orange County from a commercial perspective?
Yes, and that's been going on for. I mean, COVID was a tailwind there. The LA fires was a tailwind, but that was not the inception of that broader trend. That was going on for well before then. Some of those events that of the recent past were just fuel on the fire, so to speak. There's been some policy that's been put in place over the last probably two election cycles that have not only deterred real estate activity and business activity, but it's really just it's been a what's the best word for it? It's dampened the activity and the overall deal velocity significantly.
Mm,
The one
okay.
that comes to mind is, which is probably front and center in your world, is Measure ULA. That's the mansion tax.
Yep.
So that's a big one. I mean, there's I don't want to spend this podcast talking about policy initiatives, but there's a long list of various pieces of legislation that have just thrown cold water on the real estate and business communities in LA County specifically.
Yeah, it's amazing. The All In podcast. I'm avid listener of the All In podcast. If you've never listened to it, it's amazing. But they had Rick Caruso on at the All In Summit, and again, there's few people that can probably speak on LA as well as what he ultimately can from a real estate perspective. And it's a little bit heartbreaking. And then obviously you sprinkle on top of it, and not to speak too much policy, you sprinkle on top of it some of the bills that they're trying to pass from an AI perspective as well to put the boundaries on them. And sure, they definitely need to be rails on a certain industry, but they're looking at incredibly, that from a Bay Area perspective would scare the hell out of me of what they're trying to do and the mass exodus that might happen from a technology perspective if any of those pass. But again, we're probably getting a little too political in that sense there, Chris. But if we lead back to can we talk about, the US marketplace just quickly from maybe a little bit more rapid fire, as I said in the beginning.
Yep. Absolutely.
The office debt bubble that was spoken about coming out of COVID. I believe there's a gentleman that's quoted as Scott Galloway that said that the office buildings were going to be like the pyramids, beautiful to look at, but served no purpose. It doesn't feel like it's that, but it certainly felt like there was an incredible debt bubble that was having to be refinanced in the office space. From a national perspective, is that still something to be concerned about?
Up to this point, it's definitely has not materialized at scale the way that, Scott and, all the other thought leaders in the space have, forecasted it to. But there have been pockets of distress that have been taking place for the last 2-3 years now. There's been some very, very high profile trades across every metro in the country, large, medium, and small, where keys have been given back for like pennies on the dollar, essentially. In the same breath, there has been, the reason you haven't seen it at scale is that the lenders are playing ball with the borrowers to a much greater extent that they have in the past. So if you've heard the phrase, extend and pretend, kick the can down the road, that's what all these lenders are doing, is they're working with their borrowers proactively, giving them more time to stabilize the asset, figure out a solution, whatever that may be. Because a lot of these institutions, they've found out the hard way over previous cycles. 2008 was the most predominant one, obviously, that they don't want the keys back. It's not their core business. They don't have the expertise, the resources, the infrastructure to operate these assets, and it creates 2, 3, 4 additional issues for them. So it behooves them to work more proactively with their borrowers, with their partners, to try to figure out a solution. But ultimately, there is a kind of an endpoint on that, where they got to just kind of cut bait. And we're seeing that it's just happening in a much more controlled setting. I was having this conversation with a friend, a couple days ago, where it feels very like controlled demolition across not just Orange County or Southern California, but across the entire U.S., which, everybody's got their opinions on that, if it's good or bad, but that's the short answer to your question. And it's not just office. Office has been in the headlines since COVID, and it's kind of the redheaded stepchild, right? It was retail 10 years ago when Amazon was going to obsolete retail. It's just office's turn now, but that the defaults and the controlled demolition that I'm talking about is happening across the country, across all the different product types.
I was gonna ask a question about because you'd have a pretty decent insight to the industrial space, considering that Riverside, that is right at behind Orange County, essentially. Maybe I'm wrong with that, but it's probably one of the largest industrial hubs in the country. And I found out just the other day, and this is just me being naive in the commercial space, is that there is a REIT that you can buy, on the market, that is just Southern California industrial space. I didn't realize that was there.
Rexford Industrial.
That's it. That's the one. And I'm like, And because like this is just stems to the lack of commercial that we have on the podcast, and it's wonderful to get you on and to build a relationship through Kathy and Brenna, who have been frequent guests on the podcast and part of the network. But the gentleman that I spoke to that broadened my horizons on that was, I think, 3 years ago on the podcast. He mentioned how big a corridor that Riverside ultimately is for that space.
Yep.
So. But I do have a buddy in industrial real estate. They were a very big company locally, and they've decided to sort of just close up shop from a pipeline perspective. Both from it was a family owned industrial developer, and their pipeline was really, really long and getting through. But long story short is that they've decided just, hey, look, there's just not enough of a pipeline now. They're just going to close up shop and dissolve the company. But is the industrial space across the country doing well, or is it more pockets?
I mean, across the country, it's doing well. You're going to have your pockets of strength and pockets of weakness across all these food groups, but generally speaking, the industrial sector is still very well stabilized. The Inland Empire market specifically, I mean, you hit it on the head. It is a major hub for not only the Southwest region, but for the entire country. We consider, in my world, we call LA and Orange County are infill markets. That's a fancy way of saying that there's no more developable land, right? So you're retrofitting existing supply. You're doing a lot of redevelopment. There's very little land available for new development. So that is kind of a niche in and of itself in the commercial space, is the redevelopment, retrofitting approach. And then you have the ground up spec development that it sounds like your buddy was doing out in the Inland Empire. So as cycles go on and on, these developers go further and further out from the nucleus, right? In this case, think of the Port of LA, the Port of Long Beach as that center point, right? And they just continue to go out further and further and further. Right now, the kind of the perimeter is the Inland Empire, and it's divided into two major submarkets. You have Inland Empire West and Inland Empire East. Those are two very different markets. The Inland Empire East is probably where you're alluding to. They had some massive facilities, 500,000 foot, million square foot facilities, distribution facilities that were built on spec. That means that they were built without a tenant in tow, and the bottom of the market fell out on them, and they had a hard time leasing. A lot of it is still to be leased. So the market, the last call it 2.5, almost 3 years, has had a very hard time absorbing all the new supply that was built from 19 to 22. And we're still kind of trying to absorb that across those major submarkets, those major regions.
Makes sense. But then there's this other category that I heard of as well, and I really want to dive into your market outlook as well here shortly. But there's just one more thing that I want to get your thoughts on. It's something that I don't know if I buy into it 100% at the moment, considering the fact that it's probably just a little bit more rumor. I have not seen a lot of this myself. Not that I would, because I don't look at it on a day-to-day. But some people were saying that some institutional investors are steering away from multifamily and going into strip mall. And the reason for that, obviously, it's not a massive sector, but we actually had somebody that was talking about it on the podcast a couple of months ago that was talking about institutional investors going into the strip mall concept because of the diversity of income, because they'd been burnt previously on, say that there was an anchor tenant within a shopping mall and it goes out of business, and to fill that anchor tenant is just so difficult and all the other businesses suffer around it. Whereas if you go through, again, I'm not talking about like strip mall with, like the decrepit strip mall, but I'm talking about like just really individual shop fronts in the retail sector that doesn't have any real anchor in that retail sector, and it's becoming more of an institutional investment because of the diversity of income and easily replacing of tenants. Have you seen that?
Yeah, and that's happening across the industry on all different kind of specialty products. Institutional capital is going into strip centers. They're going into, the hot thing right now is IOS. That's industrial outdoor storage, which is basically just industrial land for equipment storage or truck parking. There obviously data centers are the all the rage right now. So the institutional players and capital allocators they're starved for yield, right? The returns in the traditional product types, the office, industrial, retail, apartments, right, that everybody's familiar with, the returns and the overall yields that they can generate from those assets, they're just not there anymore. Too much capital is chasing them. Returns get compressed, so that forces the investor to go further out on the risk curve and seek higher returns. So whether it's a strip center, iOS sites, mobile home parks are huge right now in certain areas. You see a lot of the outdoor glamping facility that's in the hospitality sector. I mean, you could list out all these different major product types, and they're going to have maybe one, two, or even three subcategories underneath them. And again, that is a function of capital chasing better returns.
Yeah. Speaking of better returns, and I promise this is probably my last peppering of a question for you, is that data centers, you just brought it up and it just triggered me immediately. It is all the rage from a real estate play. If you look at any of the research around data centers, though, that they believe that, again, it's all great. It's all good and well to go put them in, but the reality is the energy that is required or the power that is required in order to fuel those is going to be the real halt in all of that. Mm-hmm. First of all, just an opinion on it, but do you see this a space where these things are going to be built similar to the, million square foot, industrial spaces that don't get filled, and waiting until power supply, gets to a certain point that then they can fill them? Is it just well overhyped? What are your thoughts on that?
That's a loaded question. First off, I am interested in it. That's not my personal area of expertise, but I am watching and monitoring it. The power generation is the bottleneck in all of this AI hype. And how long does it take to really materialize some of these promises from these AI ventures? Yeah. But where I'm hesitant, or where I'm almost skeptical, is the timeline that it's going to take to develop and get these data centers online is one piece. The next piece is, over that same period of time, how power generation changes and how that will ultimately change the data center model. This is an entirely different conversation and outside of my expertise. But what I'm getting at is the growing adoption and growing utilization of nuclear power, and getting some of those sites back online. If you can get some of those, even the older facilities, right? I mean, I think it was either Facebook or Apple that acquired 3 Mile Island within the last year for their own data center uses. 3 Mile Island is something like 40 or 50 years old, if I'm not mistaken. So right. If you can see some of these AI, these hyperscalers acquire and get some of these older facilities back on, the power loads that can come from them are massive, and could potentially act as kind of an interim solution as we get to the newer stuff. That is my layman's opinion. I'm not an energy expert.
It's a really good point, Chris, because you mentioned it, like in LA and everything along those lines, in the markets where they're having to retrofit, because there's no land to build things. It's kind of like that maybe in the data center spaces, that as new power supplies come online, is that they will retrofit them, and maybe those newer facilities that don't have any existence and just need to wait for growth. But anyway, phenomenal point. But getting back to the real thing at hand is, we're sitting here and your episode is coming out at the end of October. And the real estate marketplace from an overall metrics perspective is one of the things that I want to get your opinion on, because, again, you have access to data points that are outside of just the normal residential marketplace that is really influenced by unemployment, and interest rates are really the driving force in any of that, supply, demand, and all of that type of thing. But it's all fueled by those two things that I mentioned in the beginning, where there's such a bigger picture in all of this that I think we miss. So give me an understanding of where you think we're going, or I don't know if that's a leading question, or give me an outlook of what 2026 looks like in your eyes for everything.
Yeah, some of your initial, your rapid fire questions here are going to tie into this, my outlook quite nicely. So maybe we can come 360 when we're wrapping up here. But I have a very unconventional, or even a contrarian view on the market. I think and this is beyond just 2026. I'm looking through the rest of this decade and into the 2030s. With this thesis and with this outlook. But I think we are in the very beginning stages of a prolonged, multi-year, multi-cycle devaluation and recalibration of how real estate is utilized and valued. And I've been going around, trying to get this conversation started in the industry. Because if we sit around and pretend like it's business as usual, the scale of disruption and the scale of financial distress is going to make 2008 look like a walk in the park. So, and I hate to be a doomer in that sense, but it's incredibly important that we get the industry talking about this. Before I go into it, I kind of need to provide some historical context to kind of set the stage here, if you don't mind.
Yep.
The real estate game that we are all playing today has been going on since 1971. So in 1971, President Nixon abandoned the financial system that was known as the gold standard for what we have today. It's the fiat regime. It's also known as floating interest rates. That's just fancy terminology for our money system was not backed by anything tangible or scarce. So they could provide liquidity at will. Now, in 71 to today, real estate benefited disproportionately relative to other asset classes, because lending against real estate was the primary way that they got new money into the system.
Right.
So in order for the economy to continue to grow, they had to expand the monetary base, which meant printing money. Now, from 71 to today, the monetary base, how much money is in the system, grew on average 6.8% per year. Over that same period of time, commercial real estate grew 4.4% and residential 5.7%. So if you actually zoom in on 08 to today, it's actually closer to 10%. It's 9.8. So just quick note, the 3 to 4% inflation figures were a complete fallacy. We were never even in the right ballpark for that. So because of the way the system was designed, people were incentivized, or people were forced to seek a safe haven, right? And that safe haven ultimately ended up being real estate. So I don't know if this is going to be a surprise for anybody, but most people don't buy real estate for the real estate. Right? They buy it because it's a savings account in one way, shape, or form. Right? Think of the stories. You got, maybe your neighbor has a portfolio of Airbnbs, or you read in the Wall Street Journal that some Middle Eastern billionaire just paid a record price for a condo in New York City just to let it sit vacant. Right? Why is that? It's because capital is seeking safety. And you can't put that money into a bank account or a savings account and collect a few basis points. You will erode your purchasing power. You will get poorer over that period of time.
Yep.
So the market participants, whether they knew this intuitively or not, they went to the next best thing, which was real estate. So they put their capital into real estate, which tracked the rate of debasement better than anything else, and it was viewed as the safe alternative, right? So
Yep.
they park that capital there, wait until they need to use it or redeploy it. They sell the real estate for a profit. The next guy comes in, process repeats itself.
Yep.
This process repeating itself for 5 decades has massively distorted the values of real estate.
Right.
And until now, there was never an alternative. There was never an off ramp. There was never a solution to this problem. And the problem is too much capital chasing too few opportunities. Right? We see it in both sectors. We have the all-time high housing prices. We have all-time high commercial real estate prices. You in one of your rapid fire questions, you asked about some of these newer sub property types, and the answer was capital was chasing yield, right?
Yep.
So that was a perfect setup for kind of this historical context. So there was never a solution. Today in 2025, there is a solution, and that solution is Bitcoin. So when you put the two assets side by side, Bitcoin is a superior financial instrument than real estate in every shape or form, right? It's
Liquidity, everything. Yeah.
No vacancy, no maintenance, no carry cost, no jurisdictional risk, no commissions. You can lend against it. It's got liquidity 24/7, 365. And it's growing at 60% per year over the last 5 years. If you go to 10 years, it's growing at 80, closer to 80%. So when you look at those two things side by side, I have a very hard time seeing a scenario where some of that capital that previously defaulted into real estate doesn't naturally migrate over into Bitcoin.
Do you see that happening at the moment with gold? Like that's sort of the same sort of thing at the moment with the historical run up in gold.
Yes, they're tied. I mean, they're tied together in the sense that they're a safe haven, they're an alternative. Yes.
Right.
But and the last thing I'll say on kind of just setting the stage here is the one knock on Bitcoin, particularly from the real estate crowd, has been that it's never produced a cash flow. It doesn't produce a cash flow. Right. And fair enough. Okay.
You don't need, but you don't need a cash flow when it has 80% returns over a 10-year cycle.
Thank you for saying that. You're exactly right. Yes, You're exactly right. But for those people that depend on the cash flow stream for real estate, right? Whether it's a retirement strategy or what have you, right? In 2025, that argument is moot. Because there are financial products, financial instruments available today to any level of investor. You can go in your Schwab or your E-Trade account right now and access these that provide a cash flow stream built on top of Bitcoin. And the cash flow streams that I'm talking, they pay quarterly or monthly, and they're paying 500 basis points, 5 percentage points more than most of your real estate will or any kind of treasury bill vehicle will. So again, whether you're talking about just spot Bitcoin itself or any of these adjacent products, I find it really hard to believe that there's not going to be a percentage of real estate capital that doesn't naturally migrate into these products because of the, again, superior features and lower risk profiles that they have. So as this takes place, this is going to take place over the next 5, 10, 15 years. It's not going to happen all at once. This has massive, massive implications on valuations. It has massive implications on leases, on loans, the entire capital stack of real estate, whether it's residential or commercial. So I'm trying to raise awareness in the industry to get everybody talking about this. Because there's a lot of incredible brain power in our space. And if we can just get some attention to it, and put some effort into it, we can come up with solutions on what this looks like, what it means, and how to navigate it, and ultimately reduce the disruption that would happen otherwise.
I think there's a part of this also that where I sort of draw a pretty close sort of, again, I haven't come to the same conclusion as what you've come to the way that you've put it on the episode today, but we did a podcast episode that got a fair bit of traction recently where it was just me verbally processing something that I had heard, in the sense that $90 trillion roughly of boomers' assets is going to change hands in the next 10, 15, 20 years, or however that works from a generational perspective. And there is another leading trend in all of this, that where I'm thinking like you've sort of just triggered something in my own head. Yes, there's going to be the transfer of that wealth. There's no doubt about that. However, that wealth is then transferring to a younger generation that ultimately is comfortable with the cryptocurrency sector and sees real estate probably as not as sexy. Now, this could be something that I've just clicked on, and ultimately the algorithm of whether it's YouTube or anything that I'm looking at the moment or being targeted is coming up. But there is an ongoing trend at the moment from online financial advisors to so many people on whether it's social media or whatever, telling people that ultimately buying a home is not a good financial decision at this point. And there's a relatively good, compelling argument here in that sense, Chris. Now, don't get me wrong, the residential real estate person in me doesn't want that to be the case, but I have to agree that on my mortgage, that I have under a 3% rate on my mortgage, still, 70% of every dollar goes to a place that I don't see any equity built. And that is a bit of a scary ongoing trend in some of the major markets that you and I live in, that are very expensive places to live in. It does make way more sense to rent a home regardless of your financial position and put it into a currency, because then I was going to ask you as well, there seems to be a bit of a trend in this as well, that it's probably a little more sexy and quote unquote safe to throw your money into an index fund at the moment as well. Regardless whether that is crypto or whatever it is, the markets are providing those opportunities. But where do you stand on sort of my comment on that?
I agree with you 100%. I'm 35 years old and I don't own my home by design. I do not view a home, a primary residence, as a investment. That home provides me with utility. It's not a financial instrument that's going to, help me get to the next level of financial independence. I'm not the only one with that opinion. That is happening at scale across the millennials, the Zoomers, all these younger generations. And what you're talking about here, as far as like the generational components and the way that people are thinking about storing wealth and how they think about value, is one, changing very quickly, very profoundly. But Bitcoin aside, part of this bigger thesis that I'm talking about here is that this is not just another cycle. This is a structural cycle change where, yes, Bitcoin is a major part of it, but when you step back and you look at how demand has shifted, right, in the commercial space, you got flexible footprints, you got work from home, you have experience-focused retail. Like, those are demand shifts that don't get put back into the bottle, right?
Yeah.
Costs across the board, residential or commercial, are permanently higher. Taxes, insurance, maintenance, utilities, all of it, right? So you can lower interest rates, but lowering interest rates doesn't fix that margin squeeze, right? So that's another thing. The other thing is the aging inventory. Commercial real estate world specifically, we have about 87 billion square feet of commercial product in the country. 54 billion of that, about 62% of it, was built before 1990. So when you look at that from a 30,000 foot view, that real estate was developed in a completely different era. It is
Yeah.
financially, functionally, technologically obsolete by and large, right? There's obviously some outliers in there, but the majority of the inventory is obsolete for the 21st century.
Right.
And then obviously you have the monetary premium that real estate is garnered, migrating into Bitcoin, and you have all these other capital innovations, whether it's 24/7 payment rails, um, fractional ownership, Bitcoin treasuries, dual collateralized loans. I mean, there's so much innovation happening on the financial side that's going to change the capital stack. These are things that are outside of the Fed's control. They're outside of any policymaker's control. And that's what makes this cycle a structural change and not a cyclical one.
Yeah. And I think that there's a part of this, though, if I look at it from a because I see an incredible opportunity, but I also see it as incredibly scary in some way, shape, or form, is because the human characteristic of a person is not changing. And people's ability to panic is probably more so now in the younger generation than what it was back in the time. And the thing where I do like real estate is that I can go through my own cycles as well, and I have quite a large real estate portfolio. I don't mind it not being ultimately liquid and difficult to sell a fair few of these assets and take some time to sell it, because it gives me an opportunity to tamper my emotions versus the liquidity that there is in cryptocurrency, the liquidity that there might be in the move to the markets versus that physical asset. It scares me a little bit, people being able to make a decision and execute on that decision as quickly as you ultimately can in the market-driven stuff. And I wonder what the effect might be eventually in that as well.
Yeah, no, that's a really interesting comment. And I mean, there's ways to structure your financial holdings, Bitcoin, stocks, bonds, whatever that is, in a way that makes it hard to
Yep.
have those knee jerk reactions. But that aside, I think it's important. I gotta say that I'm not saying that real estate is going to zero.
Yeah,
Far
no.
from it, right? Far from it. Real estate plays a vital role in human society, whether it's shelter, business, community, culturally. It's not going anywhere. But the days of buying a 3 or a 4 cap investment property, gone, right?
Gone.
The days that an apartment building that was built in the 60s trading at all-time highs, those days are gone, right? And I think a lot of real estate owners, because this has been the tried and true playbook for so long, there's a lot of inertia in the space where, oh, we've been here before, just another cycle. Rates will come down, they'll go up. We'll see this again, and that concerns me because the space, what we're talking about with the innovation, it's moving faster than humans can comprehend,
Yep.
and real estate moves at a glacial pace. So my worry there is that by the time real estate owners kind of wake up to what's going on here, the train will have left the station. That's what concerns me. So I'd rather get out in front of this as a real estate professional, as a trusted advisor to my clients. I want to have this hard conversation now so that they can be proactive and they can assess the portfolio, right? Which properties are core holdings, right? Which ones really are those that we're never going to sell, and which ones are the ones that they're a headache, they're older, they're inferior for whatever reason. Those are the
Yep.
ones that should be on the chopping block, where you're saying, as whether it's an individual, a family, or a partnership, these are the ones on the chopping block. We're cutting the fat of the portfolio and we're moving on, right? I think
Yep.
too many legacy real estate owners, both residential and commercial, they mistake a low basis for long-term security,
Right.
and that is a really, really bad idea in the
Yep.
world that we're going into.
Well, Chris, I think that that is a contrarian view in ultimately the way that most people would sort of shape up the real estate marketplace. It's probably got a few people that are scratching their head a little bit and probably got them thinking, which is the point in all of this. But that being said, I appreciate a different point of view, and I appreciate the one that doesn't need to have people feeling warm and fuzzy. That's for sure. But identifying the opportunity is the point in all of this. Identifying the ability to actually have that type of conversation, an in-depth conversation with your client about the future of real estate and the future of the marketplace, indeed. But I guess that outside of, sorry.
No, go ahead.
I just, outside of your view on that, I guess that from a closer point of view, what do you think 2026 looks like across the board? Obviously, there's the shape of things that will gradually move there, the way that you've mentioned. But what do you think about 2026?
Well, I think it's going to be a very choppy environment. In my world, in the commercial world, we specialize and break things up by product type. So retail is its own animal, industrial, office, apartments, those are all their own specialties. But generally speaking, I think it's going to be a choppy year. I think you're going to continue seeing this flight to quality trend continue, and the best properties in the market are going to outperform. They're going to have tenants. They're going to have low vacancies. They're going to have pricing power. But if you're not in that top 10, top 15% of the product type, you're going to struggle. Whether it's deferred maintenance, functional obsolescence, economic obsolescence, or interest rate policies that make refinancing difficult. There's a whole list of challenges. So it's hard for me to kind of paint that with a broad broad brush. I think it's going to be very market specific, very location specific.
Yeah.
Across all these product types.
I think it's the same with residential real estate. Regardless, I really do believe that. You've seen that in the Orange County marketplace versus LA, if we're looking at a little bit larger, but then you see that internally in some of the marketplaces in Orange County, like, for example, Eastside Costa Mesa and then Newport Heights versus then the Porch Streets. And then you go and you look at the San Clemente marketplace and the Huntington Beach market, which are the first two markets from a residential perspective that show any signs of any wavering with the average days on marketplace increasing. It's funny how if you take that on a larger perspective, it'll be the same when it comes to the commercial side of things and everything, but your quality of product. Like a great example of that is that if I went into Irvine for our office space, we're in Fashion Island in one of the buildings here. Our lease is coming up in 12 months' time, and ultimately doesn't seem like there's a great deal of pressure, but realistically there is, because this building is now full. It wasn't when we were here, and I could go into Irvine and I could get something that really is quite old and not functional, easily get it less than what we're paying here. But here they want to put my rent up 25%, and we're 12 months out from that renewing in order to stay in that location, because the Irvine company makes those type of improvements in their spaces on a consistent basis, and it's a sought after product.
You just kind of hammered home my point. The flight to quality has been going on for the last almost 3 years now, and it's not showing any sign of stopping. And where you're at in Fashion Island is some of the best product on the West Coast. So that doesn't surprise me.
Indeed. Well, Chris, we appreciate your opinion, and we appreciate you giving your insight in such a broad perspective. It's hard to get somebody to give such a broad perspective, certainly in the commercial space of things. So again, appreciate you being part of Rethink Real Estate, and we'll make sure that all of your information is below for anybody in the community that wants to explore it further with you and wants to talk a little bit more commercial.
Yeah, thanks for having me, and this was fun. If I can I want to leave your listeners with just one piece of advice here, because I don't want to be the doomer here. If I'm in any of your shoes, you need to understand that your clients' motivations are changing, right? This next generation isn't buying a home as their primary savings vehicle. They're buying it for their lifestyle. It's providing some kind of utility for them. So that means that your conversations with them need to shift from home as an investment to home as an experience. That's the first one. From there, you need to start learning about Bitcoin and sound money principles, because it's going to shape everything from mortgage design to consumer behavior over the next decades. And the agents and the brokers that can have this conversation in an intelligent, articulate way are going to stand out. It's going to be their competitive advantage, and they will ultimately win more business and outperform their competition. And I would even put AI in that same basket. Figure it out, start playing around with it. I tell younger agents all the time in my office that AI is not going to obsolete brokerage. Far from it. This is a relationship business through and through. But the brokers and agents that use AI are going to obsolete those that don't in 5 years or less. So this Bitcoin conversation is part and parcel with that AI conversation. And again, the agents that can be proactive about getting informed and educated are going to separate themselves from the pack and have a competitive advantage.
Chris, again, thanks for your insight. Nice bow to wrap it all up. Thank you, sir.
Thank you so much, Ben.
So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.